Thanks everyone for the opportunity to present. This talk is on the application of pattern search technology and finance, but I wanted to start at a high level in terms of where these techniques come from, how they relate to the human mind, and then how they actually apply to financial markets and decision making. So, because this event is taking place in London, I want to start with the knowledge. Some of you may or may not know what that is, but the knowledge is a test that you take to become a licensed cab driver of a black cab in London. So there's the center of London, a 6-mile radius out. You've got to memorize 25,000 streets, 20,000 locations, traffic patterns, construction sites. The success rate is lower than becoming a Navy SEAL, so it's quite a challenge. And it takes such intense memorization that neuroscientists, they've actually studied the brains of the cabbies. And what they've found is an enlarged hippocampus. The bottom part of the hippocampus used for location memory is a little bit bigger with this specialization in memorizing places. So I actually had a ride in a cab yesterday, and I asked the cab driver, did you realize you have a large hippocampus? And he said, yeah, I know about that study, I do. But it's still hard for me to remember names and birth dates, but there's a trade-off. Anyway, just a little bit more, he told me he literally pictures a map on his windshield perfectly. He sees all of London on a map, and when you head down a route, he sees the whole path and all the alternate routes. Very interesting. Now, on Monday this week, a Nobel Prize was awarded in medicine to 3 people, and it has to do with the brain's inner GPS. And what this years of research showed is that this is a mouse walking kind of at random around a box. But what's happening is the mind actually is creating a grid. Also, the hippocampus is creating a grid. Every one of those red dots is actually a specific neuron that fires when you pass that location in the box. So after some time, the mind develops a map. And it maps to locations within the box. You could turn out the lights, and those neurons continue to fire as the mouse walks through that area. So, what's the equivalent, I was thinking, for us? We look at patterns. Hundreds of thousands of patterns, or over a career, millions of patterns in the markets. I would suspect that we have a similar mental map, not of locations, but of patterns in markets. And maybe this room has a higher than average hippocampus size than the rest of the population. But what I want to actually do is engage for a moment that part of the brain. So, if you know what stock this is, then it's cheating. But if you don't, this happened a couple of weeks ago, flat for about 3 months, then a big spike up. Picture what you anticipate to happen next. So this is the path. This is the pattern. You've probably seen it before. It's not that common, but it's happened. What I really picture in your mind what could occur in the next, say, 1 month, looking at 3 months. And you don't have to draw just one line. There can be several outcomes, but think of a range of outcomes. And now you're tapping into that part of the brain. Now, I'll give it away. Here's what happened. Maybe it matched what you were thinking. Maybe it was within the range. Maybe not. But certainly, we were activating our experience, our memories of markets. And so this is, I'll reveal later what stock this is and use it to discuss a little bit more. But anyway, that was the outcome over the last 2 weeks. Now, that's all what's going on in the mind. How do we use technology to mimic this capability, to really match the way markets work? And I partnered up with Dr. Xiaoping Zhang. He's an expert in information processing and worked in a number of areas for the Human Genome Project. seeking out patterns in DNA base pairs, with neuroscientists looking at patterns in EEG brain activity, even with NASA doing image analysis. The commonality here is we're matching patterns to draw conclusions and using technology to do so. So, how does this all tie to finance? Well, in finance, we use typically models. You think about quants or the way academics approach finance. We talk in terms of models, which require a lot of assumptions. They require a certain functional form, and they become more and more complex as you try to describe a complex world. So this is the traditional approach. Think regression, machine learning. There are all kinds of models out there, CAPM. Now, what we're proposing and the way we look at markets is more like associative memory. You don't have to explicitly define a model. Instead, just remember the relevant analogs from the past, retrieve those efficiently to the extent they are similar to a pattern we see today, and then use those to form a range of outcomes. That's associative memory. It's analogous to some of those examples we were looking at. So this is the idea. Use associative memory. You see a pattern today, map it to similar patterns in the past based on the outcome. That's our forecast. That's how we predict. And you don't need a complex set of assumptions. Just one more analogy. This is catching a baseball. We all know how to play catch a ball. This is how you would model it out from the time a ball leaves the bat to when it hits your glove. And this is a very simplified example. It's law of gravity, the mass of the ball, velocity. You put all of that together in an equation, and then a physicist can say, here's the point where I think the ball will land. Now, that's obviously not how the mind works. We don't think through that equation, but that's what a lot of finance methodologies impose upon people to reason through markets. Instead, we use associative memory. You've seen tens of thousands of falling objects and balls coming off bats, and you picture an area where the ball is likely to land. I consider this, in a sense, it's in some ways a paradigm shift, but in other ways it's just going back to what we've always done in terms of pattern matching, but using technology. So now, compare and contrast, and I'll get into a specific finance example. There are a lot of models that are meant to forecast volatility, a range of outcomes. Garch is one of them. And just to simplify, and it's been around a while and it's gotten more complex over time, but the basic idea is if you look at a window of volatility, say the last 1 month, that's an indication of how volatile a stock might be in the next 1 month. So simple. Look at the last bit, project forward. Then people realize that when you're headed up versus when a stock is headed down, you have a different nature to volatility. When something's headed down due to the leverage effect, stocks can actually become more, it can magnify the volatility. So these are two different conditions. But then there was another realization, which is, how fast is that up or down? If it's a spike, that has an even greater magnification effect on volatility. So the model starts to look complex, like the tossing of a baseball, if I were to show you how this is written out mathematically. But all we were really doing is describing the setup, the condition, the convexity and speed of the move. So why not use the pattern? Why model? In this case, we're looking at Tesla. This is from last year. It was flat for a long while and then spiked up from 30 to 190. A very rapid move, a couple months. The idea is the way the human mind works. Let's search and find all examples throughout history where you had a similar flat and then convex move up. So these are just 7 examples. In orange is the Tesla pattern, and in blue are different stocks at different times in history where you had a similar price path. Here are 4 of those examples. Now, the red or the green is what happens after the pattern. And this is where we can derive our statistics. You have these analogs. Now let's look at what happens next. No model required. If you take a look here, this is the distribution. This is the natural data-driven distribution conditional on this specific pattern, which is what we're looking at here is each bar corresponds to one of those similar patterns throughout time, and it tells you what happens 1 month out. What happened historically to price 1 month after the pattern. So we have a number of samples, and clearly this is a bloodbath. It's far more likely to go down than up. That said, if you look at the far right, there certainly is the possibility that it continues its run-up. It's just becoming more and more rare. And if you take that distribution and you apply it to the chart itself, where we have the average expected performance and then the range of outcomes around that, here's what it would have looked like. Now, there's no way to predict what's going to happen, but you have this mental map. You have the history and the charts. Conditional, a condition similar to what we see today. That's the guide. And then it's up to us as practitioners to decide which path is most likely. And in fact, what happened was at that time, there was a battery fire. It went viral on YouTube, and people did panic. Tesla crashed. You couldn't have foreseen that event, but what you could foresee is how people will respond given bad news. And Tesla did, in fact, crash. Okay, so the stock that I showed earlier, that was Janus, when they announced that Bill Gross was joining the team. It was up 43% on a Friday, I think. So, same thing. Let's look. Let's find. When else have we seen this? It's actually a very rare event, excluding, say, buyouts, in financial sector. So we looked across all sectors throughout the US. And we found 62 very similar instances. And here's what the range of outcomes looked like. You can see very muted upside, a potential of up by 4%. A negative and kind of sharp potential drop in the near term. And then on the downside, it could come all the way back down. So, and this is, think about it, a skew that's specific to this pattern. That shape changes its form as the setup changes. If you have a rising trend or something choppy and sideways, always the statistics change because you're always looking at a different set of examples historically. Here was the actual outcome, which in this case was strikingly similar to that middle line. But of course, there are all kinds of possibilities of where Janus could have headed next. And we're only, I guess, 2 weeks in. So what I want to talk about is, this is a quantitative method. It's also tied into kind of a natural method of looking at markets. It's a great benefit. We can interpret the results. And there are ways to validate this information. So I want to go over an empirical study. What we should picture is, picture 4 buckets. So you've got the upper line. Janus could have, in actuality, fallen above that upper line. You've got between the upper bound, here's the upper bound. Then, so you've got this bucket 1. Bucket 2 is between the upper bound and the average line. Bucket 3 between the average and the lower bound. Bucket 4 below the lower bound. So 4 broadly defined buckets, Janus can fall within any one of those in actuality. So the question is, if you go back in time and you produce these projections based on patterns, then what are the actual outcomes? With what frequency do they fall within that range? We would expect 70% of the time to fall within the shaded area, 15% of the time above, and 15% of the time below. That's the a priori expectation. Here's what we found empirically. So going back 8 years, and we took the S&P 500. So every day we had a set of cones, a range of outcomes for every stock in the S&P 500 over different projection horizons, looking 5 days out, 1 month out, all the way out to 6 months out. And so over time, you make a number of projections and forecasts based on different patterns. Let's look at the top row. Using a 1 month pattern, a 1 month look back window, and finding all of its similar matches, then forecasting forward 5 days. Okay, that's test one. We made 1 million predictions over the entire period. 13% fell above the upper bound. 37 in bucket 2, 37 in bucket 3, 12% below the lower bound. So empirically, we're validating that this distribution is accurate. It's valid. The same thing is true for the 1 month, 3 month projections, 6 month. We're using different look back windows to see how much pattern should you use given a certain forecast horizon. And in all cases, the actual results correspond to this probability distribution, this data-driven probability distribution, pattern-based. And that's fascinating. So, the idea is, this. I know this is quite general, but models, a lot of models, the issue is you're trying to explain all of the data. I regress 2 variables to look for the relationship between interest rates and the stock market. But the thing is, in the markets, relationships break. They change over time. There are high volatility environments, low vol environments. There are regimes. That's true on an individual stock level and on the market level. So models tend to break down. You need something organic, dynamic, the way that technicians look at the world, a pattern-based, setup-based view. So with this search, we can accomplish that. And I think that as we develop models and as we reason about markets, we can be more explicit in terms of how we use the information. This is how decisions are made. This is how knowledge is formed, is we use the past and our experiences tied to what we see now to make forecasts about the future, a range of possibilities. So that's the bulk of the presentation, and the next part is really a specific application of the technology in a portfolio management structure. But I can stop and take some questions if there are any questions.
Yes, I'm interested to see exactly what the computer's looking for when you look at the shape of, for instance, that Tesla chart. Is it looking at the shape, or is it looking at every day's change, or just a pattern?
It's a great question. So there are many different ways to define similarity. Shape is the most, I think, common one, but you can also put an emphasis on, say, amplitude. So when doing your matching, do we put more emphasis on the size of the move and a little bit less on shape? So it is a choice. But I would say that, at least in these examples, this is a dynamic range chart. We're matching shape. And we've run studies with different similarity measures and found that there's great value. It depends on the context, though.
Thank you. It's very interesting, and there are plenty of questions coming to mind. The first one I'd like to put to you is, did you find a relation such as, you must have common patterns and less frequent patterns, but reproduce themselves over time? Do common patterns have lower risk and lower reward, and infrequent patterns higher risk and higher reward? Or do you have common patterns that have very high rewards with low risk?
Yes.
What are your top picks from your research?
It's a great question. So let me take a step back, actually. So there are known technical patterns. And there are known patterns in academia and among quants too. Momentum is a very simple pattern. It's just 2 points. Reversal is a 3-point pattern. But we have double tops and head and shoulders. So there's the world of known patterns. But then there are hundreds of thousands or millions of unclassified patterns. And the question is basically, among all of those candidates, are there some real gems that we're not talking about that maybe aren't obvious to the eye? Yes, there are. Our approach up until now has not been to identify and name them, but instead, always, every night, we're looking at every pattern that's out there in the market and then giving these natural kind of data-driven distributions. But I have some observations. We have found that prior to major market crashes or some unusual events, the patterns do become more rare. In other words, there aren't as many good matches in history. I'm talking prior to an unusual and major market move. So in those cases, we actually don't have a projection because you need a certain number of matches to make a statistical statement, but you still have information. This is rare, so it's unclear how we should behave. Value patterns. We've done a little bit of specific analysis on value patterns, where you have a hard crash and then sort of languishing for a long time, which seem to have great characteristics from a risk-return profile. But it's a green field, I would say.
I have 2 questions. The first one is regarding the system. Does it take into consideration of the, say, volatility as well as the duration when searching for the past patterns? And the second question is regarding, like, say, projection. I think, say, so far you talk about, say, to look for the empirical evidence to project for the potential future outcomes. Is it also applicable, say, to searching for potential winners based on the past successful examples? Like, say, which stock could be the next Tesla tomorrow? Thank you.
Sorry, the second question was to find potential winners?
Yeah, based on the past, like, say, if we look at the Tesla's price movement over the past, say, few years, can we use that to look for potential future Tesla? Oh,
yes, yeah, good question. The first question is, do we use volatility and duration? We definitely use duration. All of these patterns are of the same length as the original query. Now that's a rule in the system. The reason we impose that rule is because ultimately we're using the set to forecast forward. So you want to set, if you have a whole mix, take a fractal view of the world, and you have very short patterns and very long patterns, it's a little harder to interpret the predictive aspect of this. So while it is possible to stretch and compress patterns, in this example at least, the duration is fixed and the same as the query. Volatility is implicitly used. In a sense, you think about all the features of that time series. It's vol, it's moving average, it's all of the features that describe that particular price pattern, it's in price itself. And so in a sense, vol is used, a rich set of features are used in conducting the matches. One more point on that. It doesn't have to be price. We could calculate volatility and then instead look for reoccurring similar patterns in a volatility space. Maybe that would be more effective in terms of forecasting volatility. But it's a choice in terms of what data you want to use. In terms of finding winners, to the extent Tesla is a very promising looking profile, the search doesn't have to be backwards, search can be current. So take that same pattern instead of looking throughout time, you just look now and say what today has a very similar pattern. And that's how you would to use the same approach to identify opportunities today.
There's a question in the front row here.
Yeah, maybe it's expanding on that a little bit. I was just wondering if you would look back at, say, 60-minute pattern recognition, apply that to daily or weekly forward-looking patterns to increase your sample size.
Yeah, so I think there's likely great information in intraday data, which is something we haven't explored. But those are often very technical and behaviorally driven markets, and there's less fundamental information on that intraday news cycle. So we do, that I think holds a lot of promise, but we haven't yet studied the intraday.
Could you rephrase what you said in the end, that in history most extreme events are rare? Is that accurate?
Sorry.
You said in the end that most extreme events they have few examples before. Is that correct?
Oh, what I was saying, what we observed is, say before a major market crash, the patterns preceding that, it's hard to find good precedents. We think about here, maybe we found 100 matches, and for every stock on any one day, you find on average 100 good matches. When you're headed into, but not yet in, a market crash, we've observed that you find fewer good matches for the various patterns out there. They start to become more choppy, more unique, in whatever sense, more rare, so that we don't find as good of coverage, as many good examples to say, here's the range of outcomes in the future.
Do you find historical pattern matching relative? Do they correlate with intermarket inputs?
To market inputs?
Intermarket and historical pattern matching, do you look at that?
Yeah, where we would take, say, a pattern in one asset class and look in another for a similar asset class. Yeah, so that I think is reasonable. One is just, do I want to find causal relationships? So if you take crude oil and then search around the world today in a database of, say, country indices, it's a way to discover relationships. There are the usual suspects that I would anticipate, and then there's discovery, searches about discovery, things I didn't anticipate. Now, but if we think more generally just about patterns in markets, in the end it's investor behavior, whether it's silver or the NASDAQ or corn, it's people responding, it's this impulse response. People are responding to news and the signature that price leaves behind. So I've seen people say, I will only look for patterns in crude oil within crude oil. Very small space, you're not going to find that many matches. But those are the best comparables. I've also seen people say, I will look for this pattern in crude, but in any energy future contract, whether it's natural gas or heating oil. Again, they impose a constraint. I want my search space to be similar. But there are others, and I would say they tend to be more technically minded, who will look everywhere. Stocks, across countries, across futures, because they're just looking for the biggest sample set possible of people behaving in a similar fashion to see what is the subsequent return. So the rest of the presentation, this is the key. I really think that the crux is you produce a range of outcomes that help provide, it's a gut check, it's data-driven, it's objective, decision support. So that's the core. Now that said, you can say, well, what if we tried a specific money management strategy based on these statistics? Now that's really what practitioners does, is let's take this information and decide how to execute and act upon it. But just as sort of a proof of concept, we did a little research This is what I'm going to show you is very much a short-term trading strategy and a quantitative sort of portfolio construction strategy. The idea is each day I can produce a projection with a range of outcomes for every stock. So let's look at the 1,000 largest stocks in the US, basically the Russell 1, and go back in time. In this case, we started in January 06. So what would have our projections for each of those 1,000 stocks been? Given those, you can rank the universe from a most positive projection to the most negative projection. And I'm talking about short-term, 5 days, 5-day forecast. And once you have a ranked list of stocks, form a portfolio. So to keep it simple, you buy the top 100, you sell the bottom 100, market neutral. So long, short, market neutral. And every day, we reconstitute the portfolio. So each day, patterns are evolving, the projections shift, therefore the ranking of the 1,000 will change, and the top 100 and the bottom 100 shifts over time. So this is the strategy. 100% based on price patterns. And what we found is from 06 to the end of 13, and this portfolio, this long-short portfolio, would have produced an annualized 21% return with a Sharpe of 2. And it's interesting, you can make some observations. There's a great performance in the market crash. Why is that? One reason is you've got investor psychology really driving the markets. It's less and less about fundamentals in those very volatile times. Patterns take on more meaning, more importance. Not to mention you have greater differentiation when you have a volatile market, and differentiation is required to have a successful long-short strategy. So these are just some axioms. Basically, if we want an explanation, what's the meaning of a pattern? They either reflect aggregate investor behavior, overreaction, underreaction. These things create peaks and valleys. And then there are system or liquidity reasons that go into why patterns repeat. And that another axiom is there's some consistency. So while behavior and responses change over time, there is some consistency given certain setups. And this is what underlies the predictive nature of patterns. I think in this room, it's already a given that patterns have predictive information. So just some details on the study, but I'll go through this pretty quickly. Basically, we looked for patterns from 1990 until 2006, which was the beginning of our testing period. So a long period covering many market cycles to find these candidate analogs, these matches. And then we looked at a limited set of different parameters from 06 to the end of 09, and then picked the one that performed best and ran that through the rest of the period. Parameters can include things like what is the measure of similarity, that initial question asked. How do we define similarity? And also, do I look in a raw price space or a relative price space? There are decisions to be made. And it's on daily close prices. So this is, if you take just across the entire period, so we've got 8 years of predictions, 1,000 predictions every day. And if you bucket them based on which one had the strongest forecast, and down to which decile had the lowest forecast, you can see that over the 8 years, those that had the strongest projection, in fact, outperformed the index. And there's discriminatory power between those stocks that have a strong, very positive pattern-based projection and those that have a negative and strong pattern-based projection. So that's the deciles, the dark line, quintiles, the light blue line, which is buying quite a large chunk of the universe, 200 long, 200 short. In both cases, it performs quite well over the entire test period. And this is just a year-by-year breakdown. We can talk about the details afterwards if you're interested. But you can see where performance is particularly strong in these volatile market periods. And this is just a little bit of a discussion. I already covered that. Now the question is, what if we used a naive reversal strategy? Because there are pattern and modeling techniques that exist. Are we just doing something that's kind of overly sophisticated? Now, that said, there are many patterns that are unclassified, that are undefined, but that do hold information. But in this is a short-term strategy. We're using a limited amount of pattern length to forecast 5 days forward, 1 day to 5 days forward. What if we used a reversal strategy? So basically, buy the losers, sell the winners. But what we found is that, call it a naive reversal strategy, had a very low correlation with our strategy. In other words, you're making different decisions. There is some overlap, which is to be expected because when we're looking at patterns, you will pick up on mean reverting patterns. But it's a relatively weak relationship. I think I'll say this is just another way of saying there are many other kinds of patterns than mean reversal, which is traditionally used for these shorter term strategies. And then this is more, I would say, not a strict money management approach, because this is just buying every day the top 1% and shorting the bottom 1%. But the question is the information in the tails, and what patterns are showing up that are producing such great results? What's driving the train? And so we just looked at the very extremes in a backtesting system and found staggering returns. Now, certainly, there's a ton of risk along with that. But what it indicated is there's information in the extremes. What's in the middle, you'll often find, is a 50-50 case, which is to be expected. But I think, in part, the future of this is let's start studying those specific patterns. Let's see what's driving the results. Let's classify them. But continue to think in an associative memory way. We are always learning. There's new data coming into the market every single day. And that's shaping our memories. That's giving us new knowledge and new experience. And so use the mind for what it's best at doing, which is comparing, saying this is not like a circumstance today, and here are the range of outcomes I know. Technology can be quite helpful in that effort. It cannot replace the human mind, but it can be quite helpful. And I think the key is sync it up with how we think about the market. And then technology is really serving us to focus on the creative, on the unexpected, the decision maker. That's all.